So here is another video uh, by Jeff Bezos. I'm going to be providing the narration. And the core of this video is really that in 1999, somebody was interviewing Jeff Bezos. Remember that Amazon was not profitable until 2003. Um, so basically, 99, um, Amazon, 5-year-old company, was the darling of the dot-com bubble. And people were doubtful. The company's market cap had passed $30 billion for the first time in April 99. And some of the questions that people were asking was, actually, you're building warehouses all over the place. You're hiring thousands of employees. You're actually building a complicated business. Um, uh, your business is actually not a pure internet play. It's not an asset-light business. It's not an aggregation construct that is super attractive to people where you don't own the assets, but you just pretty much leverage on the existing assets that people have. And Jeff was saying, you know what? It doesn't matter to me whether we're a pure internet play or not. What matters to me is we're obsessed over the customer experience and we're able to make the strategic bets in the assets and in the infrastructure and in the capabilities that are required for us to be able to serve these customers as efficiently as possible. That was his claim in 99. And this was super critical because he had identified there were a number of requirements that customers wanted. They wanted selection, they wanted ease of use, they wanted lower prices, they wanted customer service, they wanted more information for decisions. And he knew very clearly that this business was complicated. It is not super easy. E-commerce is not an easy business to run. It's not just about opening a website and just say, no, no, no. For you to be able to guarantee a certain standard of customer experience, you need to have critical assets and critical infrastructure. Um, and according to Mr. Bezos, he was of the opinion that actually in the long term, there's no misalignment between customer interest and investor interest. For as many companies as can side with the customer interest in the long term, the investors would actually reap the reward. We have the knowledge of hindsight and we can understand what's really going on now. And we can already see who are the winners of that particular race for essentially the dot-com business models. And one of the core things we've come to see is that for as many companies as bet on the customer experience, they were able to survive. So that bet on the customer experience requires assets, and I think that's a major takeaway that we need to have from this course. That bet on the customer experience requires assets, it requires results, it requires persistence, and it requires support. And it's not just a question of whether you're a pure internet play or you're a non-pure internet play. So let's have a look at profit margins. Amazon Jumia. So Amazon is profitable. They're doing 4.1% margin, which is actually a result thing, pretty much symptomatic of the retail space. Retail margins are usually very small for those who are not very familiar with that. Usually because the cost of goods sold is usually quite significant. Your cost of goods sold could be as high as 80%, and therefore you are basically playing with 20% at the gross margin level. So which then means when you factor in your overhead cost, etc., you could basically end up with a 4% or 3% kind of net income margin. So the statement you have here is for Jumia, and you can see their general and administrative expenses for 2019 was about 144 million euros. On the right hand side, you see a breakdown of that general and administrative expenses. You see very significant staff costs. These costs are not going to come down except you go and drive significant automation. You also see professional fees. I have no idea what that is, but you can see a cost profile that's pretty much high on the overhead side. You can see pretty huge overhead. You can see, for example, office and related expenses of about 7.5 million euros. That's humongous. Um, and I think that's something they need to look at. So if somebody's saying, oh, how can Jumia become profitable? They need to go and look at how they are structured in terms of whether they want to spend on recurrent expenditure overhead or whether they want to spend on capex to build capabilities. It's really up to them. Um, they are talking about driving increase in cost, efficiency, etc., driving Jumia Pay, trying to streamline and rationalize staff costs, doing a bunch of things. But the real thing is still at the fundamental level, which is that fundamentally the way they are structured to manage this marketplace business, they are going to still be pretty high on the administrative and general expenses level. So we then come to this point where we start discussing the growth models. There are two perspectives that you can look at. There is a perspective they call the profitable growth model, which some of my professors back at Isadi University were super excited about, which is a model that essentially doesn't just drive growth, but helps you to also achieve profitability and very steady cash flows. This is a model that some people have sort of formularized and then defined as, profitable growth is equal to the product of your profitability and your growth. Profitability is now defined as your asset utilization. Remember, asset utilization we saw earlier, multiplied by your profit margin. And growth is defined as sales growth multiplied by the margin change. By the time you then define your profitable growth, you're looking at asset utilization multiplied by your profit margin, multiplied by your sales growth, and then multiplied by your margin change. Asset utilization, like we've seen before, is a ratio between sales and average assets. Profit margin is a ratio between profit and sales, and your sales growth is just essentially a metric that determines how much you are growing from year to year, and then you have your margin change. When we look at this data for both Amazon and Jumia, you're seeing asset utilization of about 1.4 for Amazon, 0.73 for Jumia. You're looking at profit margins of 4.13% for Amazon and minus 141.58% for Jumia because of the huge general and administrative expenses that they have. And then you're looking at sales growth for Amazon 20%, Jumia 24%, which is quite significant because they even have a lower base, etc. Profit margin change for Amazon was about 15%, and for Jumia was about 33%, even though it was a decline in that margin change. And then for the profitable growth, you can see that Amazon is actually profitably growing, and Jumia is actually loss-making growing. So you're driving growth, but you're loss-making, and it's unfortunate that they're actually not also building the capabilities that allows them to be able to flip this around. This is a very important observation. So coming back to our framework, to effectively run e-commerce, the following have to be well thought out. You have to think very clearly about whether you want to run a growth at all cost model or you want to run a profitable growth model. What are the levers you need to pull in order to be able to effectively run these models? And essentially, your e-commerce technology is not just apps, ladies and gentlemen. It's not just apps. We've seen images of what those technologies entail: signaling systems, very effective warehouse management systems, and we've seen the differences between marketplace and e-retail. So for Amazon and Jumia, we could say that from a revenue risk point of view, Amazon has lower revenue risk than Jumia. The inventory risk is higher for Amazon, of course, because they carry the inventory, and for Jumia, it's medium to low because they carry much lower inventory. Customer experience for Amazon is reputed. It's probably one of the best in the world. For Jumia, it's really poor, and I think people are pretty clear about this. Property, plant, and equipment is much higher for Amazon. For Jumia, it's lower. And you can see a lot of those metrics. And you can see the impact of this strategic bet they are placing, for example, on supplier control, which is higher for Amazon versus lower for Jumia. You can see the impact of some of this on the stock price as well as in the market cap. All of these things filter to the market, and eventually the market then determines and says, look, you are running a pretty sustainable business and you are running a business that is at very high risk. So when we look at Facebook shops versus Amazon model, so Facebook shops was basically Facebook said, you know what, we're going to introduce Facebook shops. We're going to be helping small businesses to start selling online. And what they're going to be doing is that on our platform, they can create their own shops. and they can run the payments program through their own shops. They can do their advertising, um, and that's it. But when you look at the structure or the framework we established a lot earlier about how you need to effectively run e-commerce by carefully thinking through the key decisions or the strategic decisions you need to take, we would see that for Facebook shops, they provide no logistic support and they actually have no capacity to provide it. Whereas Amazon is an expert in that. Facebook has significant capital. Amazon also has significant capital. Of course, Amazon has more, but I mean, Facebook has significant capital that they can leverage on. Payments infrastructure are pretty much nailed for both companies. Internet infrastructure, at least for their target markets, are pretty okay. Even though it's already been mentioned that Facebook might actually do better with Facebook shops in developing countries. Unfortunately, the internet infrastructure there are suspect. Quality orientation for Facebook shops would depend on the vendors, but for Amazon, it's already nailed. They have the infrastructure to control their vendors. They can control quality. So that is pretty much nailed for Amazon. Operational efficiency depends on the vendor for Facebook shops, and Amazon is an expert in that. So in general, you're looking at a business that Facebook is entering, and they don't have the essential ingredients that are required to be able to nail this thing. Let's not forget, e-commerce is super complex. It is not a very easy game where you just open a website, you allow people to create shops and they can pay, and then that's it. It doesn't work that way. You have issues with people shipping items that people did not order for, shipping wrong items to customers. You have quality control issues. You have logistical bottlenecks. You have warehousing challenges. You have issues around the critical assets that are required for you to be able to make demand predictions and supply optimization. What are the assets that are required for you to be able to effectively run this business beyond apps and beyond websites or web pages or Facebook pages? This is the critical difference between Facebook shops and Amazon. So this then brings us to come and start discussing our own company, Food Locker, which we started in 2017, December. So for Food Locker, the strategic decisions we have decided to take for logistics, we run both in-house logistics as well as third-party logistics. There's a number of companies that support us with last mile delivery. GoCada is one of them. We've used Safe Border at some point. There's Pivot Delivery that's just recently come on board, and this is a very promising company that's come on board with a very aggressive strategy of helping us to scale on the last mile delivery. On payments, we're basically leveraging some of the existing major players in the space, even though we are also building our own payment platform, which we would pretty much launch for our own payments users. And we're working with pretty much very solid operational efficiency requirements. Our recruitment is pretty tight. We're pretty much tight on how we run our processes, how we build our systems. On inventory versus no inventory, we do both. We keep inventory and we also do cross dock, which means we ship stuff from the dock of our suppliers to the dock of our customers. We do marketplace and e-retail. We're an essentially revenue-driven company, even though we have some room for GMV, which would kick in pretty soon. We do not do cash on delivery. We're an online payment only platform. We're driven essentially by the e-commerce technology. We're beyond apps. There's a lot of network effects we're building into our systems. We're driving critical infrastructure, especially because we sell food, so which means we have cold storage infrastructure, even through third parties, as well as even through in-house investments. We have a number of arrangements, for example, which we'll discuss later, that actually help us to build ambassador and prime networks where people can earn money for referring their friends. We're a food business, so which means that we have built the business as well as the channels to fit into the food space. And other returns are usually almost nothing because we pay a lot of attention to quality, and that is also how we control our vendors. And we have a very solid